What they actually have to do is rip the table out from under the tablecloth. Maybe he can do that miracle, rip the table out from under the tablecloth and leave the tablecloth and all the dishes suspended on the tablecloth. I don't think it's going to be able to happen, but for some reason the markets think Powell can do this miracle. Well, on Friday, we had a, quote, blowout jobs report, and 500,000 plus jobs, about 530,000 jobs, were added to the U.S. economy, seasonally adjusted in July. We're going to talk about why seasonally adjusted is important. But this was considered blowout because expectations were in the 250,000 range for jobs added for the month of July. There was a lot of pessimism in the expectations, and this number went far beyond what the expectations were for employment, change in employment in the month of July. However, this labor number is not nearly as strong as it looks. We're going to dig into the numbers and find out why that is. Also, I have an expectation for the July CPI to be much, much softer than June, as I've said before. However, I don't have an official forecast for the number, but that number is going to come out this week. And obviously, I've said this before, but July's CPI number will be softer, but this is a temporary softening in the CPI number. And the labor numbers are going to play into this inflation discussion, and it's going to mix into my third point, which is that corporate earnings in the US have shown the weakness of this economy. And that weakness is going to continue throughout the rest of this calendar year, well into 2023, which all means that the Federal Reserve is as stuck as they've ever been. They're more stuck than they've been all along, and that difficulty is only going to make itself clear as time goes on. Right now, there's a sense of optimism with the Federal Reserve's ability to guide this plane down and land softly, especially with these numbers out, but that is by no means a possibility. We are not going to land softly, and the Federal Reserve has two choices, and both of them are pretty terrible. We'll talk about that. Now, just to look at the U.S. market in the last week, the Dow was up slightly. The S&P was up actually quite a bit. NASDAQ up 2.9%. So these are great returns for the week. And the whole month of July has been really a huge bear market rally. I mean, a huge rally in the midst of this terrible recession bear market that we're having and we're going to have. But the stocks seem to be sort of ignoring that, a little bit of false optimism here. I mean, basically what happened in July is that the GDP numbers came out for quarter two, confirming that the U.S. was in recession. It was in recession from January all the way through June, and it's likely that that recession is going to continue into quarter three. In fact, I think quarter one GDP numbers came out, pretty mild. I mean, it was only negative, 0.5%. That is going to get revised in September much lower. I think it's going to be a lot lower than negative 1%. And so we have a bad recession that's already taken place, and it's going to continue. I think quarter three is going to be worse than quarter one and two. And I think quarter four is also going to be negative. So there's just a matter of waiting and seeing at this point how long and how deep this recession is going to last. When the news of the recession came out, I think the markets turned because they are trained to look for this. They are trained to say, oh, well, the economy is terrible. Employment's going to start getting hit. And because we're in recession, the Federal Reserve is going to turn around on quantitative tightening. They're going to ease, and they're going to actually cut interest rates back down, or at least pause the rate hikes. And so that gave some positive upward lift on the stock market. However, Federal Reserve Chair Powell has come out and said, no, we still have the runway, we still have high, strong employment numbers, and therefore we're not in a recession. And if it was a mystery, if the Federal Reserve was actually an independent organization, then you should have listened to Chair Powell's remarks when he was handed the cue card by the Biden administration, when this notion that we are not in a recession was being peddled by the politicians. So Secretary Yellen, the Treasury Secretary, got that cue card. Hey, we're not in a recession. We have great employment. Even though we had negative GDP, that's not what a recession is. You got the cue card to all the press secretaries and Biden himself. And even Jerome Powell got that cue card saying we're not in a recession and we still have room to tighten and raise rates. Well, that's going to lead back to some issues. Now, why the market hasn't caught back onto that and started to turn itself back down in the news or the claim by the Federal Reserve that they're going to be able to keep raising rates without wrecking the economy, I don't really know. Maybe it's just an optimism that Federal Reserve Chair Powell is going to be able to do this miracle of ripping the tablecloth out from under the dishes. Although, as Peter Schiff always said, what they actually have to do is rip the table out from under the tablecloth. Maybe he can do that miracle, rip the table out from under the tablecloth and leave the tablecloth and all the dishes suspended on the tablecloth. I don't think it's going to be able to happen, but for some reason the markets think Powell can do this miracle. Now, gold was also up pretty much in line with the broader stock market, and crude oil continues to slide downwards, and this is the big topic that I want to talk about with the expectations for CPI in June. Now, there is a lot of great resistance for crude and for oil around the $85 to $88 range. I think there's a great base of support. I don't think oil is going to be able to fall much lower, especially as temperatures start going down across the world, across the northern hemisphere. And in the United States, the closer we get to the holidays, I think the more pressure, upward pressure is going to be on oil. Like I said before, supply is not going to meaningfully grow to match the demand. And therefore, oil is just sitting at around $90 a barrel. But, if you think in context, that's actually a pretty high number. Now, we were up to 120 and we've come down since then. And that's why I think the July CPI number is going to be a lot softer than the 9.1% year over year June number. And so I could definitely see us going back down below 9%. Although it's not going to bake its way through every bit of price increases, but compared to last year, I could see something more along the lines of 8.5%. It's going to be a big drop, and it's going to give a lot of optimism that the Federal Reserve is doing its job. It's winning the fight against inflation. We have peaked, although we heard that phrase, we have peaked in inflation many times before, and it hasn't come true. And it's not going to be true this time. It's going to be another false positive signal that the Fed has won the war against inflation. It's not going to happen. Oil from 90 is going to go up. And this time, when it goes up this winter, it's going to go up beyond 120. It's going to go up to 150. Now, I was on record of saying that oil was going to be at $150 a barrel by the end of the summer. We're not really at the end of summer yet, but it doesn't look like it's going to be there. But I don't know when it's going to really break out. And I was telling people on the last podcast, don't try to time this bottom in oil. It could keep going down, and it has, but it really hasn't gone down a ton. It hasn't crashed all the way down to where it was in the previous cycle at $60 a barrel. It would still need another 33% decline from here to make that happen. And it's not going to happen. We have a soft July. We're having a soft August, but I think this is close to the bottom of where it's going to end before in October and November. And really, we have to look for December for the price to really start going back above $100 a barrel. I think $100 per barrel is a good expectation from here on out for a long period of time. So that's crude. It's definitely gone down, but this, again, is a false signal. And that means that CPI for the month of July, which is going to come out this week, is going to be a lot closer to that number, probably 8.5%. I could even see it being lower than that, but I haven't really dug in and looked at a ton of expectations. Now, this was the employment numbers, and I'm showing here just like the last couple years, year and a half of employment change by month, by sector. And you can see that here in the most recent month, July 2022, we have the 528,000 jobs added, which is higher than the past 4 months. But it doesn't really even come close to February of this year, which was 714,000. This is a seasonally adjusted chart. It's showing seasonally adjusted jobs added. And we're going to look at why seasonally adjusted is a big deal. But you can just see by sector, Manufacturing hasn't made a huge jump. I mean, the manufacturing job increase numbers for the month of July are bigger than in June and May, but not bigger than the numbers in April and in March. So it's not really a huge manufacturing number. And you look at some of the other things, obviously we have education and health, and we have some great leisure and hospitality numbers as people continue to pick that industry back up from the pieces that it was in during COVID. Now, unemployment rate has fallen from the 3.6% to 3.5%, but that again does not mean a lot, because what you have when you have unemployment numbers is how many people are participating in the market, how many people are actually searching for work. And like I said before, this number is totally dependent on the current environment. That environment is very quickly changing. And what you're going to have is you're going to have retirees who retired during COVID. Stock market was going up. They didn't want to have to go to work. Stuff was happening in their industry anyway. I'll just retire. I'll go live a simple life. Well, guess what? Your stock market, your 401k crashed. The stock market destroyed your principal. And so now you've got to go back. And of course, inflation is terrible. So you're not even able to buy as much. So you're going back to work if you're a retiree, and you're going to work, of course, not back in your old profession probably, but you're going to these service jobs. We also had no sectors with negative change, which you can see is different than the month of June and the month of April. But this is what seems to be a really positive report, especially with the expectations being very pessimistic of down to only 250,000 jobs added. This really blew out expectations. But, and that's a big, big but, let's look at the non-seasonally adjusted numbers just for a little bit of dose of reality here. We had negative actual job nominal numbers. We had jobs lost in the month of July. That's a big different picture here compared to the previous 5 months. Oh, jobs going, that's great, chugging along. Of course, you have January. January is typically the way it is there, but you have March, April, May, June, July, and you can compare it to a year previous. And some of those numbers, especially March, April, May, June, those numbers are pretty soft compared to 2021. Okay, that's fine. We're recovering from COVID. People were getting shots. They were getting vaccinated. Great. But look at July. In July of 2021, we lost jobs, yes, slightly, barely. But this month, July 2022, we lost a lot more jobs. And so this is why, if I go back for a second and compare to July of the previous year, we added 689,000. That is seasonally adjusted, and we added 528. Much less employment growth this year compared to last year, seasonally adjusted. And then you look at the non-seasonally adjusted, and it doesn't look such a bright picture. We lost jobs in July. We typically have pretty soft numbers in July, but we lost jobs. That's a big deal. You can see here, this is the comparison that you're looking for. This means that this plays right along with the recession environment and the whole story of this economy sliding from job growth and now softer job growth, and companies are cutting hiring. They're laying off workers. We just heard another headline from Robinhood laying off a quarter of their workers. And I've been on record also for saying that Robinhood is one of those zombie companies that's living on investor money, not making a profit, not even having a path toward profitability in this rough market. And of course, my prediction is that pretty soon they're going to be acquired by some larger institution. And the question just is who? But obviously they have a lot of customers. The tough thing for Robinhood is that a lot of their customers don't have that much in assets in the system. And so it's a legal responsibility to take on customers like that. Of course, there could be lawsuits against Robinhood for gamifying the investment space, and for, they could really be blamed for a lot of investment losses based on their lack of education and many other things going on the legal side. So it's going to be tough for an institution to take a lot of these customers if the customers have really low balances on the assets in place. So Robinhood, tough story, but that story is spreading around the whole tech space, and I talked about it before. job losses, job losses, job losses. And not just laying people off, but pausing hiring even for the large companies. And a lot of threatening speech from some of these CEOs and executives like, hey, our workers need to be more productive because they're not being productive enough. Well, if that goes on for long enough, then the companies just have to lay people off. That's just the reality. Now, here's the seasonally adjusted numbers again. So just turning back, and this is looking at different industries. And what's important here is to look at the blue chart, which is the current month, July 2022, versus the 12-month average change. So the trailing 12 months, what is the average monthly change in jobs in orange compared to what we saw in the current month? Well, in the case of education and health, okay, we blew it out. Lots of education institutions maybe starting back up after taking 2021 off, or the 2020 to 2021 school year off. And so we have a great growth in health and education. Slight increase in construction relative to the average, but pretty close. The one that I'm looking at the most is manufacturing, because where we have demand, and demand may be going down, but what you need is also supply. You need to be creating, you need to be productive in order to keep inflation from going up. Of course, if the money supply stays the same and demand stays the same, then to get prices to go down, you need to produce more with the same amount of labor, or you need to actually produce more goods and services. So if the manufacturing employment is not growing as fast as it was in the last 12 months, that means we are slowing down manufacturing growth, and demand and all the loose money that's still out there is still chasing after fewer and fewer goods. Of course, also trade, transportation, utilities is a really weak number, and professional business is another weak number. So anything really productive. Oh, what's another thing that's really a lot better than the 12-month average? Government jobs. Well, government jobs are not productive. They don't add to goods and services into the economy. So when we're talking about the consumer price index, the goods that people go to the store and buy that they need in their fridge, or the cars driving around, government doesn't add any production, doesn't add any output to the economy that's going to change this supply and demand ratio here. People need stuff, they want stuff, and the manufacturing jobs are slowing down relative to the 12-month average. So we're going to be producing less stuff. But we have tons more government jobs. Well, what does that mean? That means we have a lot more government workers, which means we're paying money to people who are not being productive. And those people are going and taking that money and going and spending it at the store, and that's pushing prices up. So we have a huge inflation problem, and this jobs report, contrary to what most people think, oh, this is a great jobs report for the market. No, this is terrible. This means that inflation's continuing, and it means that the Federal Reserve is in a tough spot, because as these numbers bear themselves out in the marketplace and prices keep getting pushed up, well, they have a mandate of raising interest rates, and these jobs are at risk of getting lost. If people lose these government jobs, then you have an environment where, well, manufacturing isn't impacted too much and production isn't impacted too much, but you have a lot of hurting people. And so the Federal Reserve would be tempted to then turn around and do quantitative easing. So all these education and government jobs, well, if you raise interest rates too high, of course, things can spread around. But guess what? Government employees are not really affected by high interest rates, because the government isn't going to be squeezed and forced to lay people off because interest rates and servicing debt and the cost of doing business and consumers not buying their products. Well, guess what's going to be affected? The professional business people, the leisure and hospitality, the manufacturing, those people will all lose their jobs as inflation continues and as interest rates go up. And so this is a really bad looking jobs report mixed with inflation. Knowing what's going on in the environment, the Federal Reserve is stuck between a rock and a hard place, and it's going to come to the surface. All these problems are going to emerge. It's just that right now they're just popping up in these surface level employment numbers. Another thing to keep your eye on is the possibility for revision in the next month. Of course, here's the average for the last 3 months as we look back. So usually what happens is, okay, let's take the June number, for instance. Early July, we got the June number. Then we had a revision this month that revised the June number that we previously had down. And so if you average the June, the May, and the April number, the revisions that happen in the subsequent months, that average is to drop the previously announced number by 12,700 jobs as an average for each of those months, versus the 12-month average revision, which is a huge positive 100,000 addition to what was previously announced. So we are getting worse in terms of revisions. In other words, the live data that's not being picked up in the initial surveys is coming back worse now than it was over the last 12 months. So what does that mean? This July number is probably going to get revised, and I would not be shocked if the number came back down below 500,000 in actuality, seasonally adjusted. And what that actually means is when we look at this non-seasonally adjusted, it's going to go down by a lot more than 38,000. It's going to be going down by, who knows, 50,000 maybe, something a lot closer to that. I'm sorry, it's 380,000, but it would be 500,000 in the negative territory if this revision comes out pretty bad. So don't be surprised if the next month's July number, seasonally adjusted, is revised down below 500,000. And so what does all this mean? This all means that the economy is actually in a much worse state than these numbers are saying. Of course, we also had corporate earnings. Many of them are doing better than expectations, or at least on par with expectations, and people are taking that as a win. That's also propelling the stock market in an upward direction over the last month as people were preparing for Judgment Day when it comes to these earnings reports coming out. Well, they've been coming out close to expectations, but people are kind of missing the point here. The expectations were low. In a lot of cases, expectations were 20%, 50% down from a year ago. And yeah, the companies are meeting those terrible expectations, and therefore the market is going up. I think people need a dose of reality here. People need to stop and think for a minute. Employment is okay, but Federal Reserve is continuing to notch up interest rates. Interest rates still, we're only barely above 2%. 2%. When interest rates get up to 3, when they get up to 3.5, when they get up to 4, I mean, this whole mortgage nonsense with rates coming back down below 5%. Well, in a few months, if the Federal Reserve does what it says it's going to do based on these strong numbers, interest rates are going to be 4. They're going to be 5%. But what's actually going to happen is the Fed is going to have to cave a lot sooner than that. Because even with the current interest rate, people are going to lose their jobs. Employment is going to go down, and unemployment rate is going to go way up as more people flood into the market as prices continue to go up. Even if we have a drop from 9.1% year over year to 8.5%, 8%, it's not going to go lower than 8%. So people are still going to be paying much higher prices than they were a year ago, even going forward. And I think by the time holidays come back around, we're going to be pushing back against we're going to be at least troughed, and we're going to be going way back up as far as the CPI number change for year over year. It's going to be going back up to 9, back up above 9%. And this is going to wreck people. People are going to be flooding back into the market. And actually, if you look at some of these numbers, so many of these new jobs being added are just people working a second job, a third job, because they need to pay their bills. So the economy is in terrible shape right now. The Federal Reserve says it's going to kill inflation. Recession be darned. They're going to say, screw the recession. We need a recession. They're going to keep pushing the recession as they're telling you that there is no such thing as a recession right now. And they're not going to define it. They're going to wait for a group of economists to get together 2 years from now and tell you 2 years ago we had a recession. Open up your eyes. The market is falling apart. Earnings are down, and they're going to keep getting worse. Earnings reports are going to keep getting worse. Employment, more people are going to get laid off. And as people get laid off, here's what's going to happen. People are not going to be able to buy a lot of things. It's going to be a cycle. As people get laid off, they'll cut back on their spending. Guess what? They're not spending on all those companies. Well, the company's earnings go down. As companies' earnings go down, they have to trim. They have to cut. They lay more people off. All the while, prices keep going up, putting pressure on the people who are already losing their jobs. And it's a double-edged sword that's going to kill this economy in a spiral. And guess what? If the Federal Reserve turns around, pivots, goes back to QE infinity and prints a bunch of money, inflation will not, it won't come back down to 2%. In fact, from a base of 6, 7, 8, wherever we are at that point, it will skyrocket from there. That'll be the new base. And so we're going to have perpetually high inflation. The other option for the Federal Reserve is to continue march on with the interest rate hikes. But how high do you need to get before inflation actually comes down? Inflation right now, 18%, 20%, who knows? Maybe 16 to 20%. Well, I mean, interest rates are 2. So you need to go 3, 4, 5, 6 Fed funds rate. That means mortgages rates 10, 11, 12%. Well, okay, you're getting closer, but you're still fighting against 18, 16. So you need to keep going. 6%, 7%, 8%. All the banks in the United States are out of business if interest rates are 5, 6, 7, 8%. It's not possible. This will unravel. All these companies will go out of business. All the zombie companies, so many companies' earnings will be half of what they are, quarter of what they are, an eighth of what they are, 10th of what they are today if interest rates were to go that high. So the Federal Reserve can pretend like they're doing something about this. It's not going to work. And with that, I wish you all the best. I'll see you on the next video.